wanted to go over this. Now, this is an Investopedia article. It was written about a month ago. Here we go. It was updated apparently January 31st. So basically, this guy has done this article, woman I should say, sorry, Deborah, and basically she has done some research on how the modern stock market is affected by war, and she's made a couple of comparisons here, which I thought would be really interesting to go through. So she's written here, lately, Russia has been a saber rattling and building up its military presence on its border with Ukraine, a sign that Putin may invade soon. Obviously, this has in fact happened, and drawing the US and NATO into war. There is also the ongoing possibility of an armed conflict between the US allies and Iran. Obviously, NATO and the US have not gone into war yet, and hopefully it doesn't come to that. So far, the US has spent an estimated $6.4 trillion on wars post 9/11, a sizable piece of the GDP. But how do wars and economy and the stock? How do wars affect the economy and the stock markets? Security experts are weighing in, and only time will tell. But investing experts are sending out reminders that past wars didn't push US equities lower long term. So we have here basically markets often shrug it off. So LPL Finance Research notes that stocks have largely shrugged off past geopolitical conflicts. As serious as this escalation is, previous experiences have indicated that it is unlikely to have material impact on the US economic fundamentals or corporate profits. LPL Financial Chief Investment Strategist John Lynch said, we would not be sellers of stocks into weakness related to this event, given stocks have weathered heightened geopolitical tensions in the past. And they've done a graph here. Basically, they've gone over a couple of market shock events and geopolitical events, and they've basically, listed the event date here. What did it lose on that day or the previous day if it happened overnight? And then how long did it take to reach a bottom from that point? And then also how long it took to recover. So recover would be basically back to where it was, and then the following day it should obviously be up, right? So we have quite a few different ones here. We have the US tax that were on the September 11. And on that day, we had a 4.9% drop. Obviously, one thing that you got to remember is that happened during the day. So the next day, there would have been an increase in this. So it took 11 days to reach a bottom and 31 days for recovery. And then we have things like the Kennedy, we had the Cuban Missile Crisis, and then we had North Korean invades South Korea. So a lot of different comparisons here over many different year spans. But what it shows is that recovery is generally a lot quicker than most people would predict. Obviously, we have the Pearl Harbor attack, which was a specific US attack. So it did take a lot longer for that recovery to hit. But even 307 days is within a year. A lot of people, you could actually go back to recessions, like for example the 2007-2008 recession that America had, and for a lot of those markets it took upwards of 5 to 8 years before we actually saw a recovery, depending on in certain markets. So this shows that sometimes recessions can actually be worse than these market shock events. From the start of World War II in 1939 until the end of late 1945, the Dow was up a total of 50%, more than 7% per year. So during the two worst wars in modern history, the US stock market was up a combined 115%. Ben Carlson, Director of Institutional Asset Management, in an article about counterintuitive market outcomes. The relationship between geopolitical crises and market outcomes isn't as simple as it seems. When markets can suffer, history tells us that periods of uncertainty like we're seeing now usually when stocks suffer the most. In 2015, researchers at the Swiss Finance Institute looked at the US military conflicts after World War II and found that in cases when there is a pre-war phase, an increase in the war likelihood tends to decrease stock prices, but the ultimate outbreak of war increases. However, However, in cases of when war starts as a surprise, the outbreak of war decreases stock prices. They called this phenomenon the war puzzle, and said that there was no clear explanation why stocks increase significantly once war breaks out after prelude. So obviously, if we want to draw from the comparison that we have now, there was definitely a pre-war, not a pre-war phase, but a pre-invasion phase, and what's going on now. There was a lot of tension building up to the moment, and now we've hit the day of that moment. Similarly, Mark M. Brewster, the president of Brewster Capital Management, studied the period from 1926 through to July 2013 and found that stock market volatility was actually lower during periods of war. Intuitively, one would expect that uncertainty of geopolitical environment to spill over into stock market. However, that has not been the case except during the Gulf War, when volatility was rough in the line of historical average, he said. So we've got a little graph here. Basically, they've got the return risk, or the return and the risk, if I'm reading that right. So from 1926 to 2013, we've got World War II, and then all wars combined here. So we've got the Vietnam War, for example. So we saw a return of 6.4% in large cap stocks, small cap stocks. So small cap stocks, before looking at this, I would have thought small caps are going to get hit first, because in recessions, that's quite often what happens when investors flee to those safer stocks, or the companies that are much more profitable and have those moats around them that small cap stocks do not. Long-term bonds, so obviously they decrease in return, and this can quite often be due to inflation. And then you have 5-year notes, long-term credit, cash and inflation. So cash and inflation here. So at the moment, inflation is actually higher than what these numbers are here, or these percentages are here, and that is due to COVID-19 and supply chain crisis, or at least that's how we understand it. Pardon me. In terms of the Iran conflict, however, investors have muted reaction to the headlines. If 2019 taught us anything, it's that you had to try try as best as possible to keep your process and not get caught up in the headlines. So strategist technical analyst Todd Sohn to the Washington Post. And in a sad way, I wonder if we've become used to it. I wonder if the market has learned to discount these events. It is a very true reality. I know if you go on any Wall Street Bets Reddit thread, they're all saying buy the dip, buy the dip, buy the dip. And this might actually be, the new normal. And it does seem that certain events in history, ones that are more predictable, are quite often already priced into the markets. Part of the reason for the calm may lie in the changing structure of global oil markets and how the US economy has become less vulnerable to energy price swings, said JP Morgan Fund's chief global strategist David Kelly in a note. Part of the reason may be purely psychological. Today's investors have seen the stock market recover from both 9/11 and the Great Financial Crisis. So the Great Financial Crisis, correct me if I'm wrong, was the one in the Great Financial Crisis. Can't remember if that was the one in the 90s or if that was the 2008 crisis. Arguably the greatest geopolitical and economic shocks of our time. Maybe I should know that one. This makes it easier for investors to shrug off other events. A conflict with Russia can also cause volatile oil markets, as Russia is a key producer of crude oil and natural gas, with pipelines feeding many parts of Europe. If Russia were to shut off this spigot or have its oil infrastructure damaged, it could lead to higher energy prices, interruptions to the ports around the Black and Baltic Seas, could also create even bigger shipping headaches and lead to a food inflation as grains and other staples remain stuck at sea. I was watching the news this afternoon and I did notice that a couple of the shipping carriers that go through between the US and some of those top European areas across to Asia, normally fly over Russia, and they pay Russia a small fee. But obviously now Russia and Ukraine have no fly zones, and these companies have actually said that it is unprofitable for them to go around, and it is going to affect their bottom line, unfortunately. Bottom line. Over the last few years, markets have been conditioned to not overreact to political and geopolitical shocks for two reasons. First, the belief that there would be no significant subsequent intensification of the initial shock. And second, that central banks stood ready and able to repress financial volatility, said Muhammad Ali Al-Irian, the chief economic advisor at Allianz and in Bloomberg column. But he warned that investors buying the dip should also use a selective overall strategy. This includes emphasizing up in quality trades that are anchored by robust balance sheets and high cash flow generation, resisting the strong temptation for large-scale shifts away from US assets in favor of international investments. So these are these larger cap stocks that I was talking about that investors quite often run to. So it's interesting that they talk about the psychology, and then they say, and then somebody else in another column basically says, hey, we should go to these larger cap stocks, which would imply that they're selling their smaller cap stocks, right? And reducing exposure into inherently less liquid market segments that have experienced beneficial spillovers from extraordinary central bank stimulus and general reach for yield and returns. So one example of that could be, if there was a housing market crash. Obviously, it's very hard to sell a house when markets are going down, or history has shown, and obviously the price goes down. That can quite often, if you owe more to the bank than what you can actually sell the house for, that puts you in a uncomfortable position. Next, we were going to... Okay. There was another thing that I wanted to quickly show you. So I found this recently. So basically, it was 5 of the 5 times stocks bottomed just before an invasion. So this thing here, I'm actually going to make it a little bit bigger here, just so that you can see it. I'm going to cover my face, but I would prefer that you saw it. So basically 5 times that 5 stocks bottomed before invasion. So they have the Vietnam War, the Gulf War, and then the Iraq War, Crimson Crisis, and the Afghanistan War there, pardon me. And basically what this implies is that these markets bottomed out before they went back up, except for in the case of the Afghanistan War. Obviously they went down after that. But these stocks bottomed out, or the stock market bottomed out. This is the S&P 500, I believe, from the Bloomberg. But basically that it went up. So the best time to buy, implying from these graphs, is actually just before, just before a crisis, and this shows the 18 months after these crises.